or how do we evaluate the performance of managers? And our topic is basically two parts. First part is generally talking about how we use the budget to control, and that's called budgetary control. And then the last part is how we look at a company in terms of who's responsible for what, and therefore we measure how they're performing based on what they're responsible for. It's basically called responsibility accounting. So we're going to talk, first of all, we're going to describe the concept of budgetary control. And you know we have the budget. I don't know what's happening here. We had the budget in the last spring. You performed the budget. And you have the budget set. Now we're in the next year. And we are looking at how we use that budget to control operations, and basically we're evaluating the manager of those operations, okay? So this involves a lot of budget reports, and the essence of each one of these reports is simply, hey, Mr. Manager, or Mrs. Manager, or Ms. Manager, this is what you said was going to happen in your area of control. And this is what's actually happening in your area that you're responsible for. So you see, each one of these budget reports is comparing what you said, the planned objectives, what you put in the budget, against the actual results that the accountant now is collecting. So you budgeted for the year 2022, and you did that last year. And now we're in 2022, and we're getting the results of the first quarter of 2022, and we're comparing that to the first quarter of what you said you thought would happen in 2022. So this is a feedback mechanism. That is, we're getting information back on operations. And these reports are completed as needed, but they could be weekly, monthly, or quarterly. And again, they analyze the difference between actual results and planned results. So again, overview. In the last module, we looked at developing the budget. Now we've developed the budget. And now we're in the budget year, the year that you planned, and we're comparing actual again. And we're looking at the difference. And if we are not performing the way we had planned, then we have to take corrective action, which means we have to modify our future plans or adjust our options for whatever reason. But at least now we're getting reports from the field as to what's actually happening. Now, how often do these reports come? Well, see, this is the essence of management accounting. I, as a management accountant, would be responsible for preparing reports for you as a manager. And you might be the top management and you want the sales report every month. Okay, I'll compare what we're actually doing to what everybody in the company thought they should be doing. And I will report on labor costs. What did the managers expect the labor costs to be? What are they actually? And so on and so on. So that is what's happening. And so when you're in management, you're going to get these kind of reports pretty frequently throughout the year. Okay. Now, join in. Let's just answer a few questions. Get this started. Fatma, Fadia, Aisha, come on, we need some more people. Join in, get on your phone, join in. Don't be shy. We need at least double that. Good. Thank you, Hamden. Thank you, Fatma, Jamila. There. 9. All right, let's see how you do. Start with question 1 of 7. Budget reports comparing actual results with planned objectives should be prepared only once a year. True or false? Of course, it's false. Good. Of course, we can't wait for a whole year to see how well we're doing compared to what we thought we would be doing. So no, these reports are compared very frequently throughout the year. Okay, question 2. What is it? If actual results are different from planned results, the difference must be always investigated to achieve effective budgetary control. True or false? Well, it said must always be investigated. Well, the difference might be so small that you don't need to investigate it. Yeah, so it's a tricky question. Not always do we have to investigate these, and we'll discuss that why later. Okay. Now, what we're talking about, again, the language. What you did in the last, you did the budget plan. Recall that budget plan was called the master budget because it comprised a whole series of budgets. But now we refer to that budget as a static budget. Well, what do we mean by that? Well, you see, if you've done the budget project, you realize that everything hangs on a sales estimate. So there's one level of sales activity, and then all other activity is related to that sales activity. All right. So you see that sales activity is one level. It's static. It's not changed. But when we use this to compare actual to what's actually actual to plan, we must realize the plan was based on one static number and does not allow for differences from that when you compare actual to results. It's okay if we're talking sales. Sales is output. All other budgets, you understand what I mean? But the sales is a static number. So if we're going to compare actual to static, it's okay for sales. So for example, here we have first quarter sales, actual 180. Oh no, 179, budgeted 180. Second quarter, budgeted 210, actual 199. And then we have total today, 390 and 378. So you see we have a difference here. And we have a difference in the second quarter. But when we go to look at that, what we do is we analyze that difference. And we call that difference, we don't say difference, we call it a variance. In the first quarter, the budget was 180 and the actual is 179. And that means I have $1,000 difference between the budget and the actual. That is a variance. Now we go one step further and we indicate whether that variance is favorable, we mark that with an F, or unfavorable, we mark that with a U. So you see, we have 1,000 here. We say it's unfavorable because we did not achieve the budget. We were 1,000 short of achieving the budget. Okay, now the second quarter, we look at it. The budget was 210 The actual is 995. So the variance is 10,005. And again, we mark that variance as unfavorable. So it's 10,000 favorable. So year to date now, we have 11,000 favorable. Now, is that, well, let's talk a little bit more about these variances. Let's look at the first quarter. You estimated as a manager that the sales would be 180. Well, it came in at 179. Now let's be honest here. We don't know exactly what the future is going to be like. And if I say the future is going to be 180 in sales and it comes in 179, is that good or bad? Well, I take that variance of 1,000 and I take it as a percentage of my estimate, 180. So my estimate is less than 1% out. So I'm pretty well on the mark, except I'm 1% off. That's no big deal. I mean, that's nothing to worry about. In the second quarter, though, you see I'm 10,500 out on sales of 210. Well, if I take 10,500 as a percentage of 210, I'm getting upwards of 5%. Now, 5% out on your estimate is getting to be significant. That means I should be looking into this. Why am I out 5%? I mean, if I'm about 1%, okay, but 5%, is there something happening here that I didn't anticipate? Are we failing to deliver? What is going on? Are we getting hit by the competition? Has there been a change in sales price? Why am I not achieving my budget in the second quarter? That's, as a manager, you would be looking at. So you see, 1% or less than 1%, we don't tend to worry about. But when you get up around 3, 4, 5 or more percent, yes, that gets the attention of senior management. So therefore, it should get your attention as well. All right, so answer this question for me. The master budget is called a static, is most useful in evaluating and managing performance and controlling costs. True or false? He tricked us last time. What's he going to do this time? That is false. It is useless to us. That master budget comparing costs, now that's input, to the level of activity as expressed in sales, which is output, is not very useful to us. Why? Here's an example. Here we have Barton Robotics, static budget, based on the production of 10,000 units. So now we're not talking a sales budget here. We're talking a production by output. It was built on sales, but okay, so this is production of 10,000. The manager figured at that level of activity, the indirect materials would be 250. Indirect labor would be 260. Utilities would be 190, property tax 180, depreciation. Okay. So now we're into that year and we collect the actual. Those are the planned results. We collect the actual, and here's what the report is. You see, the report is for Barton Robotics, manufacturing overhead static and budget report for the year ending. And here you have the budget on one side, the actual on the other. And there's your budget. And it says that you say the cost would be 250, but the costs are 295. So the difference is 45,000. And that means you spent 45,000 more than you estimated. So that's unfavorable. You said 260 for direct labor. but it's 312. Again, you're out by 52,000 and you spend 52,000 more. So that's unfavorable. Utilities, 190, but you spent 225. Again, unfavorable. You're right on property taxes. Can anybody see what the problem is here with this report? This report indicates that the manager of this department is not doing a very good job in controlling costs. That's what the report says. What is the problem with that report? Can anybody point to it? What is the problem?
Problem as in?
Come on.
So the problem
Pardon?
here is that the cost is not being controlled. The material, labor, and the utilities costs are, or maybe it's not budgeted right in the first
That's
place.
what the report says.
Yeah, variable budget
fair?
is not
Is
right.
this a fair evaluation of the
No, maybe the
No.
budget was not
Okay.
right. The budget was not right in the first place.
Why? What's not right?
Budget.
The variable budget is not right.
What do you mean? The budget was not right?
Yeah, when it was budgeted in the first place,
So what?
when the values were budgeted, the
What, you mean-
indirect material.
The two. That's not right, the 250?
Yeah.
How do you think he got that 250?
From last year budget, maybe. The actuals.
Yeah. What else did he do? How did he come up with that 250?
Normally in budget, they check all the reports and invoices from last year and see how much we spend in this area. Then they add that budget. Yeah.
Okay, that's what we did when we did the planning of the budget, the static
Yeah.
budget. You're
But they
absolutely
did not.
right.
Yeah, but they did not put
But-
additional contingency. Yeah.
Also, the budget is for 10,000
why?
units, while the actual is 12,000 units.
So what does that mean?
So the units that are produced are more than what is budgeted.
Right?
So if we take per unit, probably that.
So why are the costs different? Why are the costs different?
Okay, direct labor.
Okay, what kind of cost is indirect labor? Fixed or variable?
Variable. No.
Variable.
Yeah.
No, fixed. Indirect is
No,
So-
fixed.
fixed. It's fixed.
Yeah, fixed. Labor are two types.
What's indirect material?
Indirect material is like
Variable.
glues.
What's depreciation?
Depreciation is
variable?
fixed. Property
Right.
tax is fixed. Supervisor is fixed, but first three are variable. Variable are changeable cost. It can go up and down.
Okay, how do they vary? With what activity? There's
Number of
two types
units
of activity,
produced.
production and sales. So how do they vary? With what?
Maybe production.
Right, you're absolutely right. Right. Now the manager was told that the sales were going to be something, so the production budget, he built 10,000 based on the sales, and he came up with these numbers. But the production ended up being 12,000. So doesn't it make sense he's going to spend more on indirect materials to produce 12,000 than he estimated on 10?
Yes.
Yes.
These are variable costs. They vary with output, and the output was estimated at 10, but the actual is 12. So the report is not very good because it's you heard the term apples and apples. Well, they're comparing apples and oranges here.
No,
They're two different
it's not.
things.
Yes, it's not an apple to apple comparison.
Exactly. And that's why we need flexible budgets. What do I mean by flexible budget? I mean, let's see, how did he build the budget at 10,000? Let's figure out how he built that budget at 10,000 and then recalculate the budget as if we produced 12,000 and then compare it to the actual. You see, what they're saying here is that unfavorable variance of 132,000 is 12% over budget, and that is disastrous for a manager. But the comparison is not relevant. It's meaningless to compare actual variable costs for 12,000 output with budgeted variable cost of 10,000 output, units of output. Why? Because we learned way back that variable costs increase with activity in direct proportion to activity. So the budgeted variable cost should be increased proportionally. And what we do is this. We say, okay, look, the manager at 10,000 said it was going to be 250. So obviously, he's using $25 per unit. Well, if he knew that the output was going to be 12,000, he would have budgeted 300,000, which is 12,000 times $25. You got 300 down there. For labor, he figured $26 per unit. It's a variable cost. So if I'm going to produce 12,000, I would predict it would be 312. Now utilities, 228. So now, when you build the budget, you're going to compare the new budget, that is called a flexible budget. We took the master budget, which was at 10, but we flexed it. We said, okay, let's pretend the manager knew exactly what was going to be produced. What would the manager have said? And then compare that to the actual. So what it looks like is this. At 12,000, the budgeted would have been 300,000 for indirect material. He came in at 295. So you see, he did 5,000 better than expected. The labor is right on. The utilities estimated 228, came in at 225. So he's 3,000 favorable. So you see, this manager did a very good job at managing costs. But you wouldn't know that if you compared actual to the static budget. You have to take the static budget and say, okay, in the static budget, we have these variable costs that he's predicting, and we're going to restate that static budget at the level of activity that was actually achieved. Okay, that's the idea of a flexible budget. And that's how we use the budget to control. We don't actually compare to what except for sales, we don't actually compare the numbers to what actually happened, budgeted numbers. We flex those numbers. Okay, start the quiz. What's the primary difference between a static budget and a flexible budget? Still trying. Static budget contains only fixed costs, while a flexible budget is variable. Static budget is at a single level of activity, the flexible budget at different levels. Static budget is prepared only for the units produced. No. The answer is number 2. The static budget is at a single level, where the flexible budget are at different levels. All right, here's a case study of Fox Company. They use the budget to evaluate the performance of their managers, but they do a flexible budget. Compare actual results to the manufacturing overhead costs. The master budget for the year ending and so on. So here you have the variable costs at 120,000 direct labor hours. So there's your level of activity, 120,000. At that level, the indirect materials would be 180, indirect labor would be 240, and utilities 80. The fixed cost would be as follows. Okay, so that's at 120. So to develop a flexible budget, what we do is we take the master budget and we say, okay, it was built at 120. What would be for the variable cost, the unit cost that the manager was using to predict the total? And so you take the 180 and divide by the activity 120,000, and you see that the variable cost per direct labor hour was $1.50. Okay. For indirect labor, it's $2, and for utilities, it's 50. All right, so I have the unit costs for the variable. Now the fixed are fixed, so I don't have to worry about them. Now the actual comes in, and they did 9,000. So that 120 is for the year. And for this month, first month, we did 9,000 actual results on the right-hand side. We don't change the actual. But now we build the flexible budget at 9. And we say, okay, the indirect labor would be the actual output of 9,000 times $1.50, or 13,500. The indirect labor would be 9,000 times 2, and the utilities 9,000 by 50. Now the fixed costs are fixed, so they're 15, 10, and that. Now we compare it to the actual. The actual says that we actually spent 14,000. So the difference is 500, and that variance is unfavorable. The actual direct labor was 17,000. We said 8, and again, okay, we come in under by 1,000, so it's favorable. Utilities, again, were unfavorable. So we totaled it up, we're out 400, but it's favorable. We came in fixed costs. There could be a variance in fixed costs, but in this case, there is none. So all in all, the manager did a very good job here of controlling costs. All right. Question number 5. The formula used in development of flexible budget is total cost equal fixed cost plus variable cost per unit times the activity level. It's up. Yeah, very, very good. Very good. Rewards more. The flexible budget can be prepared for each of the types of budgets included in the master budget. Keep in mind, the master budget is a combination of all budgets. It starts with the sales budget, then the production, then the purchasing. So we can develop flexible budgets at all levels in the master budget. Is that true or false? That's not a tricky question. Yeah, oh no, it's true. We can do it for everyone. You see, when you look at the master budget, remember the first lecture I gave you was the income statement. And I said the revenue or the sales was output and everything else was input into that. Well, here we're talking about. Now, the sales activity is the static number, and that's output. But everything else that goes into the master budget is based on that sales number, and that's input. Those are costs. And the manager's ability to control those costs is measured by making flexible budgets at different levels of activity. All right, so that concludes this part of it. Let's see what happens. Hey, there we go. Okay, good. Now, what I have to do is I have to go to the second part of this, which is responsibility accounting. I got a separate module for that. Responsibility accounting, that's this baby right here. All right, so we're going to have to ask you later on. Oh, maybe you're going to have to scan that code again. Just scan the code so that you get this slide presentation. And you can answer the questions in this. All right. So we'll start again. You don't have to sign in, but when it comes to the quiz, you can sign up. So scan that code one more time. Are we ready? Now, again, this is performance evaluation, but the first part was how we use the budget to keep control of you managers. I'm senior management. All right, you signed in. Okay, responsibility accounting. Well, if you're responsible for something, then that means you have control over something. And if you're a manager in a company, you have control over certain operations within that company, and therefore you're responsible for those operations. So we're talking now of adding value to the company. So what you have to do here is control costs. And therefore, you see, when you enter business, you're going to be at the departmental level. You'll be managing a department, and then you'll be promoted to managing a division, and then you get up into the senior management. But at all levels, you're responsible for different levels of activity. And therefore, that responsibility means you have authority over those costs. You can't control those costs to some degree because you have authority in making the day-to-day decisions. And the idea here is that we can take all the costs in a company and trace those costs to the person who is responsible for managing those costs. So we're looking at costs and revenues that are specifically related to your level of management responsibility. That means you have control over them, all right? And we use this to evaluate how well you're controlling them. But we must make sure here you're not actually, if you're a manager of a division or department, there are some costs you can't control. You can't control the rent. You can't control the depreciation on the building, but those costs are actually assigned to you because they're in your division or your department, but you don't have any control of them. So when we look at evaluating a manager, you as a manager, we have to distinguish those costs which you as a manager have control over. We simply call them controllable costs. And controllable costs are all costs controlled by the manager. Now, at the senior level, all the costs in the company are the responsibility of the senior management. As you go down, fewer costs are controllable. All right, so the level of your responsibility. Now, the concept here, and I introduced it briefly when we talked about budgetary variances. The concept here, when we're evaluating performance from a senior management's point of view, is called management by exception. Keep in mind, the reports we're going to get are comparing what you estimated to what is actually happening. And we recognize we're dealing with the future. We can't be right on. But if we are within 1 or 2 or maybe even 3% of what our estimate, if the actual is within 2 or 3% of what we estimated, that's not much to be concerned about. We're going to spend our time looking at those variances that are over 3%, upwards of 5, 6, and 7%. Now, I use the term, as you're getting up around 5%, I said that's significant. Another term you will hear is called materiality. If the difference, the variance, is very small, we use the word insignificant, or immaterial. If it's immaterial, it means it's insignificant, it means it's very small. And management by exception means that you have all kinds of things to manage. You're not going to worry about the small stuff. Don't sweat the small stuff. If it's 1%, 2%, Mafi Muscala, move on. Okay? But if it's getting up to being material or significant, like 5%, you know that is going to catch the attention of senior management. So you better have some answers as to why. So therefore, you look into it before senior management comes down on you. Okay? So management by exception is you focus on those major differences or variances. So let's see if we understand that concept. Now this is a new game. It's not added to the game before. Oh, let's see if we can beat Shaheen. Everybody, gang up on Shaheen, okay? Okay, question 1. I'm only kidding, Shaheen. The accumulation of accounting data on the basis of individual matters responsible for day-to-day activities. Decision about the activities is a flexible accounting, responsibility accounting, or master budgeting. The accumulating of accounting data based on the individual managers who have the authority to make that. And the answer is, yeah, of course, it's responsibility accounting. It's not master budgeting. And I don't know what flexible accounting is. Flexible budgeting, I know. Okay, question 2. Cost is considered controllable given level of management responsibility if the manager has the power to incur the cost within a given time period. The cost has not exceeded the budget amount and the master budget. Oh, come on now. Obviously, the manager has the power, has the say over that cost. That's what controllability means. Okay, a responsibility report should I don't know why it's so slow today. Come on now, let's go. What's going on here? Oh, no, there we go. Should only be prepared at the highest level of responsibility. Be prepared in accordance with GAAP, generally accepted accounting principles. Should only show only those costs that a manager has control. Oh my goodness, folks, are you not listening to me? No, only those costs that are controllable. Let's hope we get better at this. Costs incurred indirectly and associated responsibility are considered to be the rent. Is it non-material, non-controllable, or non-controllable? Cost incurred indirect. Remember an indirect cost? Remember the language. Indirect cost means I cannot measure accurately, so I must allocate it. And therefore, if I allocate it, it is non-controllable. Okay? You've got to understand the language here. Management by exception. Can only be applied when comparing actual to master, can be applied at each level of responsibility, is most effective at top levels. Well, that's a little better. You probably, yeah, that's right. Good. All right. Now, we're talking in general here, responsibility accounting, management by exception, only those costs that are controlled by the manager, and so on. And we're going to develop the reports according to the responsibility level of the manager. We must be aware that there are 3 types of responsibility areas or centers, we call them. And the first is a cost center. Now, a cost center is a responsibility center in which the manager is responsible only for controlling costs. That is, this cost center, the manager incurs cost and has nothing to do with generating revenue, has the authority to incur these costs, and therefore should be evaluated only on his or her ability. Okay? That's what a cost center is. Now, let's see if the next one. Let's take an organization that we're all familiar with. Does everybody know this business? Anybody ever heard of this great university? Anybody there?
Yes.
Do I hear yes or no?
Yes.
Oh, thank
Sure,
you.
Doctor, yes.
Yes.
All right. You are familiar with the operations of this business. Now, take the concept that I just mentioned about a cost center and think about the operations within Abu Dhabi University. Which managers within the university would be evaluated for controlling costs only? That is, their area of responsibility is referred to as a cost center.
Finance team, right?
Finance, that's a good one. Finance doesn't generate the money, they collect the money.
Collection. Yeah, collection.
So the manager of the finance would only be
Registration. Yeah. Maybe
right.
registration.
Who else?
Would it
What
be
else?
dean of each
Pardon?
dean of each businesses?
HR? Did you say HR? Hey?
No, dean, the dean of each unit.
You're not coming through clearly. What did you say?
The dean of each like College of Business. There's
Not
a
the
dean for
dean,
College of
not-
Business. No?
No, no.
I
He's
think
responsible
registration
for
only, yeah.
generating profits, revenue. Registration, okay, move in, move in. What other operations within the university?
Tuitions, maybe extra classes.
Who
Something.
do you call when you have trouble with respondents? Pardon?
IT.
IT department.
Who? I'm hearing different things. What did you say? Could you speak clearly? I heard you. What did you say?
IT department, sir.
Hello?
IT department.
3 people talked at the same time. I didn't get the answer.
IT.
What other operations? IT, very good. Absolutely. The manager of IT is only responsible for controlling costs, does not generate any revenue. So the manager, that would be called a cost center. What else would be a cost center?
Maintenance department, maybe, sir.
No, think of something else.
Marketing.
Some of you are probably going into
Marketing.
marketing. Well, that's an interesting one. Marketing, yeah, they help generate. Something else, something obvious.
Procurement.
How about HR? Some of you are going into HR. The manager of HR is only responsible for controlling costs, right? So you see, when we go back to cost center, incurs cost, but does not generate revenue. Usually a production department or a service department. Maintenance would be one. Security would be another area of responsibility. There's a manager for facilities management, security. That manager is responsible for controlling the costs in that area, security costs and so on. So those would be cost centers. Now, compare that to a profit center. A profit center is a center where the manager is not only responsible for controlling costs, but for generating revenue. So therefore, who would be, I should, profit incurs costs and generates revenue. And they're judged as a responsibility center. So who would be a profit basis? You already mentioned that.
Student intake department.
Type in your answer here. Hey? The what? I think you have the right answer. What did you say?
Student intake department.
I didn't get the first part. What did you say?
Student intake, the department which is in
I hear
charge of
each department. Something's not coming through.
student intake.
Oh, student intake. Okay, but who's responsible?
Individual.
For what? No, sir.
The individual.
Student intake department. Well, we don't have a student intake department. We have finance department. They collect your money.
So who's doing the
But
marketing
who's
and sales?
responsible?
Sales and marketing.
Yeah, but they also incur costs. Okay, no. Who within Abu Dhabi University would be evaluated by senior management as a profit center? That is judged on how much revenue they generated minus how much costs they incurred. Now, somebody gave me the answer in the last time. Who's that? No, not sales. Oh, wait a minute. Individual deans. Yes. Yes. You understand what I'm saying? When you look at Abu Dhabi University, you have the School of Business. The School of Business is run by the dean. Now, not only is the dean responsible for controlling costs, faculty costs, and all that other costs, but is responsible for attracting business students. So therefore, the dean would be evaluated based on a profit center. Now, the dean of engineering is the same. They have to generate, they look at generating revenues by attracting engineering students, and they have to control costs, and they're judged on a profit level. So yeah, the deans at COBA, they have to, there's a dean responsible for the law program. Those deans are evaluated based on the revenue they generate and the costs that they control. Okay, so i.e. it's a profit, but it's not quite a profit. It's the revenue minus the controllable costs that the dean is responsible for. But so we call it a profit, but it's a profit center idea. Now, in every university, you'll hear the engineering department say, oh, we generate more revenue than the business department, and so on. And that might be true, because they might have more engineering students. But the business department is the most profitable department. Why? Well, you see, engineering has to have all these labs and all this equipment in order to teach the engineering students. Where here in accounting or business, well, the old saying is that it's only chalk and talk in business. We used to use chalk on the blackboard, but now we use computers. But you get the idea. Very inexpensive in delivering business courses. So business division of a university is often quite more profitable we generate more revenue, and they're right. But accounting say, hey, the bottom line is we generate more profit. All right, now the third one, I wouldn't expect you might have the ability, is an investment center. And this not only, the manager here not only is responsible for evaluating or for controlling costs, but generating profits, but also the investment that is made in the area of their responsibility. So they're evaluated on the profitability as a rate of return on the investment of the funds. So this is ROI. All right, they must have significant influence over the amount of investment. Now, who would that be in Abu Dhabi University? Anybody got a quick shot at this? Managers that be on an ROI basis? Well, let's say that you are in charge of main campus of VC. That's good. That's good. You see, you're the what's the term I'm trying to use? The chairman of the. You're the head of Abu Dhabi University main campus. We have a head of Al Ain main campus. We have a head of Dubai main campus. So you see, there's a different amount of funds invested in Abu Dhabi than there is in Al Ain, than there is in Dubai. So the investment amount is twice that. So it's not fair to compare the manager or the chair of Abu Dhabi University in Abu Dhabi to the one that's in Al Ain, because Abu Dhabi is 5 times bigger. So it should generate 5 times more profit. So we use ROI. All right. Return on investment. Okay. Conceptually then, let's try these questions. All right. The questions, points for faster. The linen department of a large department store is a cost center, a revenue center, or a profit center. Linens, they sell sheets and pillowcases in the department store. Carrefour, as my French Canadian friend would say, Carrefour. Would it be a cost center, a profit center, or a revenue center? Right, very good. We can track how much linen is sold in that department, and we can track how many costs are incurred in that department. We can come up with a profit idea for that manager. A foreign subsidiary for a large corporation, is that considered a cost center, profit center, or an investment center? I should have shortened the time on some of these questions. What do you think? Yeah, you're getting the idea. That's good. Question number 8. A maintenance department of a manufacturing company. Would that be a cost center, an investment center, or a profit center? Again, too much time on this. Gives you time to look up your notes. All right. What do you think? Everybody should get this one. Yeah, everybody did. Right on. Okay, who's our leader this time? Shaheen again? Yeah, Shaheen. Fatma's right out there. Aisha, Iman, Fadia. Good. All right. Jamila never got in the race, but that's okay, Jamila. It doesn't count for anything, but now responsibility and cost centers, we already. For a cost center, the report is the type of report that we already looked at. We're comparing the budget to the actual. But again, the language is here. We're not talking flexible. We're talking flexible budget for indirect materials, indirect labor. Yes, flexible budget to actual. Now, supervision here is a fixed cost. But we're going to include that in this manager's department because that manager has control over supervision. So you see, supervision is a controllable cost. So therefore, you notice that it is a fixed cost, but it's controllable. Depreciation, not controllable. Property taxes are all fixed. But for a cost center, we look at the flexible budget estimates versus the actual, and we also include in fixed costs that are controllable. Now, for a profit center, now the term profit is, you understand the idea, is based on controlling costs and earning revenue. That's the reason it's called profit, but it's not really a profit. What we have to do here is distinguish between those fixed costs that are controllable, and if they're controllable, then we refer to them as direct fixed costs. And a direct fixed cost relates specifically to one responsibility center. For example, if I'm talking IT, a direct fixed cost might be the depreciation on the equipment in IT. You see that depreciation cost is a factor, it's a fixed cost, but it's sort of controlled by the IT manager. So therefore that cost, depreciation on computers that are used in the IT department, benefits only that section. Whereas property taxes would not be. They would be indirect costs because they relate to the company as a whole. So now we don't use the term profit, we bring in a new term. And we call that term controllable margin. Of course, a contribution margin is variable costs, remember? So variable costs are controlled by the manager, but also there are some fixed costs. So we subtract the controllable fixed costs and we come up with a controllable margin, which we basically call profit. So it's the terminology again. So here we have the Marine Division Department Manager, flexible budget, sales, okay, 12,000 actual. We have the cost of goods sold, so on. We come up to the contribution margin, 540. And we look, the actual 504, we have an unfavorable variance. But also this manager controls part of the cost of goods sold is fixed, but that's controllable by him. And part of the selling and admin is fixed, and that's controllable by him. So they're included in this. So it's sales minus these costs gives me the controllable margin. It's called a profit center, but actually it's not profit, it's controllable margin. Now for an investment center, the same thing, only go one step further. We compare that controllable margin to the amount invested. So we look and we say, okay, the controllable margin for Elaine is $1 million. The average operating assets that the head of Elaine campus here, the campus chair, has 5 million, so the return on investment is 20%. Now the operating assets are only those assets that we are using to earn revenue used in operations. Okay. And we come up with what's called ROI. Of course, there are problems here. How do I define assets? Is that book value? Is it original value? Is it depreciable value? What have you? So here we have a investment center, and you see we have down here controllable margin 300, and we divide that into the assets, which are 2 million. And we get an ROI of 15. Is the budgeted? 13.2 was the actual. So that's how we evaluate managers who are responsible for our investment centers. And that basically concludes. Now, responsibility accounting is an overview of the whole corporation. The idea is that the costs incurred, all costs incurred are the responsibility of some managers, different managers, maybe different levels of managers. And the accountant's job is to relate those costs to that area of responsibility. Are there any questions?
Yes,
Again,
Professor.
this is all about manager performance evaluation.
Can you hear me?
Budgetary control is part of it. Responsibility accounting is another. Yes, what's the question?
Yeah, so from this operating assets, 2 million, that's a fixed number that finance would provide, right?
Hello?
Hello?
I did hear you. What happened?
The 2 million, that is a fixed number that will be
Somebody have a
provided by
question?
finance?
Okay, well, let's. What? Sorry, you're breaking up. What is it?
The 2 million, it's a
I
number that's
heard
provided by
beginning
finance.
assets. What's that mean? Yes, yeah. We look at how much is invested in assets here in the LA campus. Let's just take the LA campus. All right, the building is worth this much, the equipment is worth this much. What's the depreciation on the building? How do I evaluate those assets? Finance department will come up with that. And you can argue that. Oh, that brings up a point. You as a manager of the cost center or as a profit center, you may argue that this cost is not that controllable by me. It's allocated. And if you're manager of if you're the head of the campus here in LA and the campus in Abu Dhabi, you're sophisticated enough to question, what is that 2 million? It has to be operating assets. How did you evaluate that? Is that original cost minus depreciation? Okay, is that market cost? How did you come up with the 2 million, Mr. Accountant? And the accountant, if he's good, should be able to come up with it. And it should be fair. Because you see, you're evaluated based on that. So as a manager, when the accountant comes, don't be afraid to question. Actually, that's what education's all about. You've been educated now in management accounting. You understand the tools that we use to control operation. You understand the tools we use to plan operation. You understand the tools you use to make decisions. So in controlling operations, of course, you're evaluating. And this is a major area, evaluating performance. So what education basically means is that you should have the confidence to ask good questions. Don't be shy because you don't know the answer. You have enough knowledge, skills, ability that you can ask intelligent questions. And that's all that's asked of you in business. Ask questions. And that was a good, intelligent question. How did you come up with 2 million? Very good. It has to be annual. Wait a minute, beginning minus the end of the year divided by 2. Okay, I understand that. Operating, You're not charging me with some vacant land over here that happens to be on our property, but I'm not using. Okay. And you know, are we using historical cost of the assets or depreciable costs? And so on. You should question them. And that's what the MBA gives you, is the ability to ask good questions. It doesn't. Good on ya. Okay.
I'll zoom in a little bit.
Let's make it large.
Larger.
Yeah, good, good.
Okay. Royce has prepared the following list of statements about budgetary control. Identify each statement as true or false.
Okay.
Can all hear me?
Yeah.
Yes.
Budget reports compare actual results with planned objectives.
True.
True. All budget reports are prepared on a weekly basis. False. Management uses budget reports to analyze differences between actual and planned results and to determine their costs. True.
What's it going to be?
As a result, yeah, it's true. Third one is true.
Okay,
Yes.
good.
As a result of analyzing budget report, management may either take corrective action or modify future plans. True. Budgetary control works best when a company has an informal reporting system. False. Am I right?
I don't know.
False.
Somebody says yes, so keep going.
The primary recipients of the sales report are the sales manager and the production supervisor. Not sure about the production supervisor.
Okay.
False.
It's the primary recipient is sales manager. That I understand because I'm a sales manager. I do
Yeah,
get
yeah.
production
7 is
supervisor.
right. Sorry.
Are you a cost center? Yeah.
So it's false, right? Because production supervisor might not get the sales report, right?
Okay.
But it also makes sense because the production supervisor would have to plan the production based on the sales.
Right. But it's already been planned.
Okay. Okay. Correct. Yes, it's false. Yes.
Yeah. Okay. You got it.
The primary recipient of the scrap report is a production manager. True.
Yes. True.
Yeah.
The static budget is a projection of budget data at a single level of activity. True.
True.
Top management's reaction to unfavorable difference is not influenced by the materiality of the difference. False.
False. False.
A static budget is not appropriate in evaluating a manager's effectiveness in controlling costs unless the actual activity level approximates the static budget activity level or the behavior of the cost is fixed. Keep one.
Okay.
That requires rereading. Static budget is not
True.
controlling costs unless the actual activity level.
True.
True. Okay. Let me try. Yeah.
Very good. Very good. All right.
Next question.
Next question.
For the quiz, so it's going to be all true or false questions for the quiz.
What?
If it is this kind of true or false,
On the quiz, I don't think the ministry would approve of that. Okay, you get ministry approval. I'll put it on the final.
I don't know. Usually, maybe some students working in Ministry of Education.
Yeah. Okay. If you got WASTA, go ahead. Get the approval.
100 company expects to produce 1,080,000 units of product XX in 2022. Monthly production is expected to range from 72,000 to 108,000 units. Budgeted variable manufacturing cost per unit or direct materials $5, direct labor $6, and overhead $8. Budgeted fixed manufacturing cost per unit for depreciation are $2 and for supervision are $1.
Okay.
Manufacturing budget for the relevant range value
18.
using 18,000 unit increments.
Okay. So what you're asked to do here, this isn't actually a report. This is actually the way we develop flexible budgets. Okay, the activity level is that first one. What's the activity level?
Activity,
Yeah. Activity level, okay, so now you want finished units. What's the production? No, make that activity level and then one below it, finished units.
The first one is activity level, then finished units.
That's right. Now stick in the units. We start at 72.
Yeah, I have other number. Okay.
Add 18. No. 72, add 18, which gives you 90. And 18 again, which gives you 108. Okay?
Then 108, Shaheen.
oh, like this? You're with me, right?
Hey?
Yeah.
Yeah.
Now, okay. Direct material. So first would be direct material.
Variable
That's
costs
right.
first,
No,
then
you
direct.
want variable costs,
Variable.
right? Put
Yes.
in that box variable cost, direct material. You're right. Now you take the units times the unit cost.
So 72,000 multiplied by direct material.
Which is
It's fine.
6.
$5.
I
So-
have it 6.
Okay. And 90,000 times 5. I'll do that, 450. I'll use the calculator the good Lord gave me. All right. Then we have direct labor. You do the-
Overhead?
No, direct labor.
Then overhead.
Is that the last one? Yeah, then overhead. Okay.
Yes.
Okay. So these are the variable costs, and they vary with the level of activity. The level of activity is expressed anywhere from 72,000 to 108. So when the actual comes in and it's 85, well, then you're already prepared. You know how to do the flexible budget at 85. Okay, so you get the totals. You're just banging out the numbers. Good. Total them up.
Now we finished the variable cost part. Now we would have to go for
The fixed.
fixed.
Now the fixed is easy because it's fixed, it's fixed, it's fixed. It don't change.
That's depreciation and supervision.
Right.
And depreciation above it's written $2. So
Cut.
for,
No. Yeah, no. What?
here.
No, it will be
No.
okay. We have 18,000.
Right.
multiply by, I have other numbers.
You have different numbers, eh?
No, but then here it's
Yeah.
written budgeted fixed manufacturing cost per unit for depreciation are two per unit and one for supervision. How is that possible?
So you have 18,000 multiplied by 2, then by 1. صح دكتور, right?
Oh, okay, okay. It's annual, okay? Right? So your annual production is 1,080,000 times 2 divided by 12, because we're talking monthly.
Ah,
Mm.
tricky one.
So
Multiply by 2, divide by 12. So that's
Right.
180,000.
Okay, put that in 3 places going across because it doesn't change.
yes.
Right. I do the same for the next one. It's straight, yeah. They give it to you in annual and they have to say the fixed costs are based on this annual amount. But they're not going to change on a monthly basis. Doesn't matter if I do 72 that month or 82, it's going to be that amount. And then you just total them and add to the variable. Good.
So here it's going to be
Total. Yeah.
so total costs.
Yeah, total cost.
Oh, there is a slight mistake here. This one, it's not. Yeah, sorry, that's it. I clicked
Total fixed cost.
All right.
Okay, we got that right. I hope
Good.
everyone got the same. The numbers would be different, but the process is the same. We'll move on. Okay. Okay, we'll move on. Amber Company is a newly formed company specializing in high-speed internet service for home and business. The owner company into 2 segments: home internet and business internet service. Each segment is run by, while basic selling and admin are shared by both segments. Danny has asked you to help him create a performance reporting system that would allow him to measure each segment's performance. To that end, the following information has been collected on home internet segment for the first quarter of 2022. Can you hear me?
Yeah, keep going.
Okay. So this information is only provided for home internet. Okay. So there is service revenue, budgeted versus actual, allocation portion of building depreciation, advertising, billing, property tax, material and supplies, supervisory sales, insurance, wages, gas and oil, and equipment depreciation. The numbers are provided on budgeted versus actual. Prepare a responsibility report for the first quarter of 2022 for home internet service. So you would have to, for month ended March, for quarter ended March 31, 2020.
Okay.
goes vertical. So the first,
Service
Okay.
revenue.
what is that again?
Service revenue.
Service.
Okay, service revenue. Okay, so what was budgeted? Service revenue, 21,000 and 22. I'll copy this one. 21,000 and 22.
Mhm.
Then you will subtract the budgeted minus actual.
So the actual is 22,008 minus 21. So we have 1,008. Is it favorable or unfavorable?
Favorable.
Great. And the next is
Yeah, we exceeded the budget in output.
yes. So next we'd have to go.
Where
Variable cost.
Now, these are allocated.
So
Okay.
we'll have to go. We'll have to go by this list, right? As
No. Oh, not necessarily. No.
not all, not all. We have
No, the
material and supply.
Okay, you want the variable, okay?
Material and supplies.
Very good. Yeah.
Wages.
What else is variable? What else is variable?
Weights and gas and oil.
Yeah, good.
What is that?
You want the variable costs. Those are the costs that the manager can control.
Gas and oil. The last one.
Okay, so we'd have to do it. So material and supplies.
Right. Only those costs a manager has control over. That's a variable cost and direct fixed costs, which we will call controllable costs. Controllable fixed costs. Okay. All right. Good. Now get the difference and then indicate. Now keep in mind, this is input into sales. So if I used more, it's unfavorable. So if the number is high, actual is greater than budget, it's unfavorable. Whereas when we talk sales, the actual was better than the budget, it was favorable. That's output. So get the difference.
So here the actual is less, which is again favorable.
Yes, I
Actual
think.
was less than the budgeted. Yes, that would be favorable.
In this case, 2520 minus 73. Here it is 210,
Right.
unfavorable.
Okay, you got it.
The other one is 504.
Ashu, 504.
Yes, unfavorable.
Ashu.
Okay, then just total them up.
Oh, okay.
No, wait. Okay, sorry. I went to the second step, which is contribution margin. Sorry.
Yeah, the next level is contribution margin. You're right. So you see how we use the CVP format here? Remember
The other one
CVP?
is 1050.
Now, what is that again?
Okay.
1050.
Total variance.
How much? How much is that?
Okay. What's the variance?
No, we would add this up in this case.
No,
Here.
no, subtract the budget from the actual, yeah. What do we come in?
We'd have to just subtract. Okay. Correct. Okay. I forgot that. minus 6216. 378.
How much?
378.
Okay, favorable, unfavorable.
Unfavorable because this is higher.
Okay, now look, go back there. Okay, you had 336 favorable, then you had 210 unfavorable, and you had 5. So if you add the 210 unfavorable, subtract the favorable, you get the unfavorable of, so everything's correct. You see what I just said? Good?
Yes.
All right, now, sales minus variable cost gives me what?
Contribution.
Right,
So
contribution.
here we will subtract the total, the variable costs from the service revenue, or?
That's
No,
right.
revenue minus total variable cost.
Exactly. And again, get the difference. And it should be 378. No, it should be, but again, okay, now be very careful here because you see the favorable up there is output.
Okay, so it's an addition.
Yeah,
Variable.
and then and subtract the input. Okay,
Oh, it's 1008 plus 378. No, it's unfavorable, so it's not subtract.
okay,
Should be variable.
right, you subtract. All right, now go to controllable fixed costs. Which costs would be controllable fixed? Go back to the question. And then we have to
Salaries.
tell us.
So here it is unfavorable again, right?
I don't know. Subtract favorable and unfavorable. Yeah. Well, no,
No, okay.
Variable.
unfavorable.
Okay, now what is that? Okay,
The fixed cost, controllable fixed cost, the next one.
Right.
So we will have the salaries
Right.
and insurance and
Okay.
equipment.
no salary as that is wages. We already put that. So
No, we have supervisory salaries, another one.
and okay, and insurance. You said insurance
Yes, insurance.
Yeah.
and
Equipment.
no, that's fixed.
Depreciation.
Sorry, fixed.
Yes, right.
What equipment depreciation?
Yes.
Yeah.
Then we total controllable fixed cost, then contribution margin. Controllable margins.
No, but equipment depreciation is controllable.
Yes.
Okay, okay,
What?
that is
Yes.
here. Okay, we'll just have to copy paste that. Okay.
That's right. Copy paste.
So in this case, the actual is higher. So No, this is favorable, right?
Yes.
This is also favorable. صح?
Yes. Yes. صح.
We have to add this up.
Oh.
Correct?
Yes. Yes.
Now the final is, what's the final line item?
Margin. Right, Doctor?
Yeah. Controllable margin.
So controllable margin would be,
No, total controllable fixed cost. You got that?
yes.
Yes, we did it
Okay,
right.
just controllable margin. There you go. And
So
subtract from contribution, subtract the controllable fixed costs. So this is a new term, controllable margin.
So this is favorable. No, okay, this is confusing. Unfavorable because, correct?
I think so. Let's see.
Ah, because you said you think so.
Well, I thought wrong then.
No, no, no. No, I was, because this
Go ahead.
number, no, what's confusing here is this number is higher than this number, and the actual number is higher than the budgeted number.
Yeah.
The controllable
You see,
margin.
but it comes in, controllable margin takes in the favorable sales revenue. That's the trouble.
Okay. Okay,
It's
so
not-
controllable margin is associated with sales revenue. Okay. So
It's a combination of input and output.
okay. So, and precedence is for the input.
Right. Okay, move on. All right. What do we get next?
Presented here is information related to Southern Division of Novak. We don't know what Novak is. Contribution margin 1,212,100. Controllable margin 900,460. Average operating assets 4,093,000. Minimum rate of return 19%. Compute the Southern Division's return on investment and residual income. Okay,
Okay.
so what we remember, return on investment, the controllable margin divided by
The average.
operating assets.
Average operating.
Average, okay, sorry, average. So 900,000, sorry,
Right.
divided by 4,093,000.
Right.
22%.
Okay.
Okay. Residual income. Can someone remind me?
Take a first step, take the average operating assets, multiply by the percentage they give it to us, the 19.
Okay.
Very good. Residual is the amount of
0.19.
Controllable margin,
in excess.
minus.
Yeah.
What is that again? Okay. So first we have to average operating assets 9,
Yeah,
getting 77,670. Then
okay. Then take the controllable margin, subtract it from the number you have now.
okay, يعني controllable margin, which is 900,460 minus the number I
Yes.
Right.
Yes.
That's what they earned. What did they expect to earn? They expected to earn 19% on 4039. So how much did they earn in excess? That's residual means excess.
Okay, so that's 900,460 minus 777,670. So the answer I'm getting is 122,790.
Okay.
Thank
Very
you.
good.
Thank you on the residual income.
That's right. Everybody understand residual income now? It's the amount of controllable margin in excess of what they expect me to get. They expected me to get an ROI of so much percentage on average assets. So I did better. Okay, so it's two ways of looking at it, the ROI and residual income. Next.
Why did we, okay. So component that I don't understand. Why are we given contribution margin information?
Well,
Okay.
we're talking beyond that now. We're talking profit. Okay.
Okay.
So we bring into play, well, we're talking controllable margin, not contribution margin, controllable margin.
Okay, this is fun. This is match the following statement to the appropriate term.
Okay.
The review of budget reports by top management directed entirely or primarily to differences between actual result and planned objectives. Review of budget by top management directed entirely or primarily to difference between actual result and planned objective.
Okay, what do we call that concept?
Management by expectation?
Yeah.
Yes. Management by exception.
Okay. A part of management accounting that involves accumulating and reporting revenue and cost on the basis of individual manager who has the authority to make day-to-day decisions is responsibility accounting.
Yes.
Preparation of reports for each level of responsibility shown in the company's organization chart.
Reporting system.
What is that?
Responsibility.
Yeah, system. Good.
Responsibility reporting system.
Okay. A projection of budget data at one level of activity, that is static. Static, right?
I don't know.
I think
Yes,
who was helping me,
keep going.
Fatima?
No, keep going. It's
Budget
static.
maybe. Yes.
Cost that a manager has authority to adjust within a given period of time. Controllable.
Controllable costs.
Right.
The use of budgets to control operation. The use of budgets to control operation.
Budgetary control.
Budgetary
That's
control.
right. Yeah, good.
A projection of budget data for various level of activity. Projection.
Flexible budget. Yeah.
Somebody have a cat there?
That's me.
That's a kid, I think.
Oh, child, yeah, okay, go ahead.
A responsibility center that incurs costs, generates revenue, and has control over the investment funds available for use. Investment.
Right.
Investment center.
Yeah.
Costs that relate specifically to a responsibility center and are incurred to the sole benefit of the center.
Fixed
Direct fixed cost, maybe.
Costs that are related specifically to a responsibility center are incurred for us. Yes. A responsibility center that incurs costs and also generates revenue, profit center.
Right.
Costs which are incurred for the benefit of more than one profit center.
Indirect. Yeah.
A measure of profitability of an investment center computed by dividing controllable margin in dollars by average operating assets.
ROI.
Yeah.
Okay. Good.
Is that? I can't see that. Ah, here. Yes, we got all that right.
Great.
Thank you. We move on to the last one. We have
Yeah.
1 minute. The South Division of Blue Spruce Company reports the following data for the current year. Top management is unhappy always with the investment center's return on investment. It asked the manager of South Division to submit plans to improve ROI in next year. The manager believes it is feasible to consider the following independent course of action. Increase sales by 300,000 with no change in contribution margin percentage. Reduce variable cost by $150,000. Reduce average operating asset by 4%. Compute the ROI for the current year. So the ROI for the current year would be, percentage would be controllable margin percentage divided by controllable margin divided by average operating asset. Right?
So far.
So guys, am I right in what I'm saying?
Yeah. Now, but you don't have controllable margins, so you're going to have to figure it out. How do you figure it out?
So we'd have to sales minus
The variable cost.
variable cost would give us
Contribution margin, and then minus.
contribution.
Control fixed cost.
Right. Very
Okay, so
good.
we'd have to
I'll
do
go
2950 minus
1.
Mm-hmm.
Not the
1
same
million.
number.
So the contribution margin is 1,032,500.
No.
Yeah.
How much?
Yeah, so 2,900,000.
No, we have the same number. Okay.
2 million. One. I'm getting 32,500. Until
You're breaking up. Sales minus variable costs gives
1
me the
million.
contribution margin minus the controllable fixed costs gives me the controllable margin.
the controllable margin that I'm getting is 427,500.
It sounds reasonable.
Huh?
Okay, now divide by the average assets, operating assets.
So,
8.55.
Okay,
Someone asked me, Cave, like how?
pardon?
Somebody asked me, how am I getting that?
How are you getting that?
I think it's wrong, but let's see, no problem.
No, it's a basic subtraction. Sales
Yeah.
minus variable cost minus controllable fixed cost. So
No, no,
CPI
okay, contribution margin minus, okay, good. Okay, go ahead, you get the same thing.
Okay, using the ROI equation, compute ROI under each of the proposed course of action.
Okay,
Increase sales by 300 contribution margin percentage.
all right, so
Mean-
now you have to get the contribution margin percentage. So what is it? So sales minus variable cost gives me the contribution margin. Take that as a percentage of sales and then add 300 to the sales and take that percentage to give you the new contribution margin. And then subtract controllable fixed costs to give you the new controllable margin.
No, so totally confusing. Okay, so the earlier contribution margin. Okay, I have to find.
Yeah, what's the contribution margin as it is now as a percentage of sales?
So for me, it's 1,032,500.
Okay, yeah, as a percentage of 2,900,000.
That is 35%. That's 35%.
Okay, 35, keep that 35. Now add 300 to the sales. What do you get?
Okay, wait a second. So 2,950 plus
Yeah.
300. So that's 3,250,000.
Now get the new contribution margin, take the same percentage, 35%, and you got the new contribution margin.
Yeah, so I multiply this amount by 35%. The new contribution margin is 1,137,500.
Okay, now subtract the controllable fixed.
Okay, which is 605,000.
Controllable fixed,
Yeah,
605,000. Okay, so now what's your new controllable margin?
532,500.
And your average operating assets are the same, so therefore, what's your percentage? ROI.
10.65.
Okay, put that in, 10.65. So that alternative looks pretty promising. If I can increase revenue by 300,000, and keep my average assets the same, then my ROI would jump by almost 20%. Okay, now the next one is reduce the fixed costs. No, the controllable fixed. So go back to the original. What was your original contribution margin?
Here, no, you said fixed cost. No, it says reduce variable cost.
No, go back to the original. The contribution margin is the original sales minus the variable cost. What's that contribution margin? And then subtract the new controllable fixed costs.
New, no. No, it says reduce variable cost $150,000. Meaning this part, reduce this by 100.
Oh, no, it's reduce variable costs or reduce fixed costs? Sorry.
Variable cost.
Oh, okay, reduce the variable costs. So go back. You've got a new contribution margin. You have the sales, but you reduce the variable cost by 15. So now you got a new contribution margin.
No, so the
And
sales
then-
will remain the same. Sales will remain the same at 2,950,000, but the
Right.
variable cost would be reduced by 150,000.
Okay.
2,950,000 minus 19 minus variable cost will be minus the controllable 605. Is everyone getting the same number? 5.55%? Because you guys are saying that you have the same numbers as well.
I shouldn't have the same numbers.
I'm having
Some-
another number.
I have
check.
different.
Oh. No problem.
No, I have the same basic numbers, but the results are different than you.
Play.
I don't know.
We'll see. Okay, action number 3 is basically reducing the average operating assets, just 5 million by 4%, right? So 5 million multiplied by 0.96. Am I right?
Yeah.
So the new average operating assets is 4,800,000.
Okay, now go back and take the original controllable margin.
Just 295 minus 1917 minus 605 divided by 4,800,000. So it is action number 2 is wrong.
Right. Okay, it would not be the same. It would go up. Variable cost went down. My contribution margin would go up. My controllable margin would go up.
So we'll do that
So
again.
it will be better than what you had, 8.55. It wouldn't be worse than 8.55. So now
Yes,
go
we'll do that
back.
again. So maybe
Take the
sales number
sales. Take the sales.
2950. Okay.
Which number?
Is 950,000. So variable cost reduced, right? So the
Right.
new variable cost would be 1917.
Okay, so the contribution margin will go up by that same amount, 155.
No, so minus. So the new variable cost is 1,767,500. Am I right? I'm basically
And the contribution margin will go up by 155. So what's the new contribution margin? Or one, is it 155 or 150? Sorry.
150. So 2950. So the new contribution margin would be this number, that is 1,767,500. I subtract 295 minus 1,767. I'm getting 1,182,500. That's a new contribution margin. No.
Okay, now take the controllable margin off of that. The controllable fixed costs, sorry.
Okay, so when I subtract control, getting 577,500.
Okay, take that as a percentage of average operating assets.
11.55.
How much?
11.55.
Okay. Of course, it would have to be more than 8%, what the original is.
So action number 2 seems to be correct.
See if that's correct. Check
Yes,
it.
it's correct. It's correct.
Oh, it is. Okay, good. Well, that completes it. Thank you very much. Any questions?